Here's something nobody tells you about investing. The hardest part isn't picking stocks. It isn't timing the market. It isn't even understanding what a dividend is. The hardest part is starting when you have no idea what you're doing, and everyone around you seems to already be 3 steps ahead. So let's fix that, because in 2026, the barrier to entry has never been lower, and that's both the best news you'll hear today and possibly the most dangerous. Let's rewind for a second. 20 years ago, if you wanted to invest, you called a broker, an actual human being with a landline and a commission structure that made sure you paid whether you won or lost. You needed a few $1,000s just to open an account. The whole system was designed to keep regular people out. Fast forward to today, you can buy a fraction of a Tesla share with $7 from your phone while waiting for coffee. The game changed. But here's the uncomfortable part. Easier access doesn't mean better outcomes. In fact, it might mean the opposite. So, what is the easiest way to start investing in 2026? The answer is stupidly simple. So simple it sounds boring, and that's exactly why most beginners ignore it and lose money trying to be clever. You open a brokerage account, you deposit money, you buy an index fund, you leave it alone. That's it. 4 steps. No stock picking, no crypto gambling, no day trading, no trying to beat the market. Just steady, boring, compounding returns over time. But let's break down why this works, and more importantly, why the alternative almost always fails. First, the brokerage account. In 2026, you've got options: Fidelity, Vanguard, Charles Schwab, interactive brokers, even apps like Robinhood or Webull if you want something slicker. Here's what matters. You want zero commission trades, access to major index funds, and a platform that won't gamify your decisions with confetti animations every time you buy something. Because yes, that's a real thing. Some apps literally celebrate when you trade, as if spending money is a victory. It's psychological warfare disguised as user experience. Choose the boring one, the one that feels like a bank website from 2003. That's a feature, not a bug. Opening the account takes about 10 minutes. You'll need your social security number, a bank account to link, and basic info. No minimum deposit required at most places now. You're in. Step 2, deposit money. This is where it gets personal. How much should you invest? The classic advice is to have an emergency fund first, 3 to 6 months of expenses sitting in a high-yield savings account. Because if you invest money you might need next month and the market drops 15%, you're forced to sell at a loss. That's not investing, that's expensive gambling. So the money you put in should be money you won't touch for at least 5 years, ideally longer. Start small if you need to, $50, $100, whatever doesn't make you nervous. You can always add more later. The point is to build the habit, not to get rich in 6 months. Now, step 3, the part where most people overthink themselves into paralysis. What do you actually buy? Here's where the magic happens. You buy an index fund. Let's pause and explain what that is because it sounds more complicated than it is. An index fund is a basket of stocks that tracks a specific market index. The most popular one is the S&P 500. That's the 500 largest publicly traded companies in the United States. Apple, Microsoft, Amazon, Google, Nvidia, all of them bundled together in one investment. When you buy a share of an S&P 500 index fund, you own a tiny slice of all 500 companies. You're not betting on one winner, you're betting on the entire economy. And historically, the U.S. economy has gone up. Not every year, not every month, but over decades, the trend is clear. From 1926 to 2023, the S&P 500 averaged about 10% annual returns. Some years it's up 30%, some years it's down 20%, but zoom out and the line goes up. That's the bet. Not that you're smarter than Wall Street, just that capitalism, on average, works. The fund you want has a ticker symbol. Think of it like a stock's name.
For Vanguard, it's VOO or VTI. For Fidelity, it's FXAIX. For Schwab, it's CHCB. These are essentially the same thing, low-cost index funds that track the broad U.S. market. The key word there is low cost. You want an expense ratio under 0.1%. That's the annual fee the fund charges to manage your money. Anything higher is a ripoff. VOO, for example, charges 0.03%. That means if you invest $10,000, you pay $3 a year in fees. Compare that to an actively managed mutual fund that charges 1%. That's $100 a year. Doesn't sound like much, but compounded over 30 years, that fee difference costs you tens of thousands in lost returns. Low fees are everything. So you buy the fund. You own it. Now comes step 4. Leave it alone. This is the hardest step because your brain is wired to do something, to check it, to react, to optimize. The market will go up. You'll feel like a genius. The market will go down. You'll feel like an idiot. Both feelings are lies. The entire strategy depends on ignoring short-term noise and letting time do the work. If you invested $10,000 in the S&P 500 in 2000, right before the dot-com crash, and did absolutely nothing, you'd have over $50,000 today. Even through 2 recessions, even through 2008, even through 2020. You didn't beat the market, you just didn't get in your own way. Now, let's contrast that with what most beginners actually do. They open a brokerage account, they deposit money, and then they try to get clever. They buy individual stocks because they heard someone on a podcast say Tesla's going to the moon. They buy crypto because a TikTok influencer promised financial freedom. They trade options because Reddit made it sound easy. And for a few weeks, maybe even a few months, it works. They're up. They're winning. They tell their friends. Then reality arrives. Tesla drops 40%. The crypto market collapses. The options expire worthless. And suddenly the account is down 30, 40, 50%. Now they're stuck. Do they sell and lock in the loss? Do they hold and hope it comes back? Do they deposit more money and try to average down? None of these are good options. They're all versions of the same mistake, trying to beat a game they don't understand. Because here's the uncomfortable truth. 90% of active traders underperform the market over 10 years. Not because they're dumb, because the market is ruthless, and professional investors with billions of dollars and supercomputers can barely beat it. You, with your phone and your lunch break, are not going to outsmart them. But let's say you do everything right. You buy the index fund, you ignore the noise, you let it sit. What actually happens? Let's run the math. Say you invest $500 a month into an S&P 500 index fund. That's $6,000 a year. Assume the historical average of 10%. After 10 years, you've got about $100,000. You contributed $60,000. The market gave you $40,000. After 20 years, you've got $380,000. You contributed $120,000. The market gave you the rest. That's not a trick. That's just compounding, the 8th wonder of the world, according to Einstein, though he probably never said that. But the point stands. Small, consistent contributions plus time equals life-changing money. So why doesn't everyone do this? Because it's boring, because it's slow, because it doesn't feel like winning. Humans are wired for instant feedback. We want to see the line go up today, not in 30 years. We want the dopamine hit of a 10% gain in a week, even if it means risking a 50% loss the next. The index fund strategy requires patience, discipline, the ability to do nothing while everyone around you is buying meme stocks and bragging about their gains. It's not sexy, but it works. And that's the irony. The easiest way to invest is also the least exciting. The strategy that requires the least knowledge is the one that beats almost everyone. Now, let's zoom out. What does this mean for you in 2026? It means the opportunity is real, the tools are free, the barrier to entry is gone. But it also means the noise is louder than ever. Every influencer, Every ad, every app is trying to convince you that passive investing is for suckers, that you need to trade, to hustle, to beat the market. They're lying, or they're selling you something, usually both. The truth is simpler and less exciting. Start early, invest consistently, buy the whole market, ignore everything else. Will it make you rich overnight? No. Will it make you financially secure over decades? Probably. And in a world where most people are one emergency away from broke, that's not nothing. Here's the final thing nobody talks about. Starting is uncomfortable because it forces you to confront how little you've saved, how late you think you are, how far behind you feel. But the best time to start was 10 years ago. The second best time is today. Not tomorrow, not when you understand it better, not when you